to miss it. Well, of course, Goldman Sachs is not alone in its bullish prediction on gold. There's no shortage of gold bugs out there. U.S. global investors expect the rally to continue into 2011 for gold and also other commodities, including oil and copper. Well, joining us now, U.S. global investors Brian Hicks, co-manager on nearly $3 billion of investments portfolios. And, of course, Ron is staying with us. Brian, Goldman is saying 1690 at the end of 2011. Where do you sit with that forecast?
Well, I think that's a reasonable forecast. I think my sense is if we get to that level, we could see a run that goes much beyond that, perhaps back to its inflation-adjusted high of about $2,300 an ounce.
Based on what?
Well, I think that the structural factors for gold are still in place. We still have rising fiscal deficits, problems with deficit spending at the state and local government level, central banks engaging in quantitative easing, and real low interest rates. There's no opportunity cost to own gold at this point in time, and we're seeing more and more participation by the generalists out there, and we think that we're going to continue to see more buying on the horizon.
Is it predicated also on the U.S. dollar remaining or becoming increasingly weak?
Absolutely. It's really more of a structural issue, and we do think that the dollar will continue to decline. We're going to continue to see the powers that be try and offset structural unemployment, and we think that's going to require a cheaper dollar.
Brian, Ron and Sana here. I have just a couple of concerns about the forecast, and I don't disagree with you in any way, shape, or form, except that it's been shown recently that the gold ETFs own about 9 years' worth of production that's still in the ground. China has just deregulated to allow their funds to buy gold ETFs outside China, and the Wall Street Journal reported the other day that there is a single entity that owns half the copper on the London Metal Exchange. You can't get much more of a crowded set of trades than these. Is there some downside risk to the forecast of these metals going up?
There's always that potential. I will say, though, with respect to the gold ETFs, that money has actually been quite sticky. Whenever we see a pullback, we continue to see more and more ounces being purchased through the GLD, although the futures may be going down that particular day. So we're seeing very consistent, very steady retail buying into these ETFs, not just here in the U.S., but abroad as well. I know in China there's been a big pickup in gold imports, a lot of demand there from retail folks in China. This is really a broad-based bull market that is really just sort of moving into the middle innings, in our opinion.
And I see that for your gold stock pick, you've got Barrick. For oil stock pick, you've got Anadarko. And copper stock pick, you've got Freeport McMoran. Brian, thank you very much for joining us today. Just ahead on Street Signs, the risk trade. With the European contagion spreading, how can you get ahead of that? The best currency bets next as Street Signs comes right back.